Gold just hit $5,000 per ounce, $5,000. And silver, sitting at a historically cheap ratio to gold, is barely moving. If you have been asking yourself, why is silver not moving while gold is hitting record after record? Today, we answer that question completely. With data, with the actual numbers, without drama. This is your gold 5,000 silver price disconnect complete breakdown. Why gold is at 5,000. Why silver price today is not reflecting that move. And exactly what the data says happens next for silver investment. My name is Stack AG. We invest with logic, not hype. Let us get into the data. Why gold hit $5,000, gold did not reach $5,000 by accident. 3 structural forces drove it here simultaneously. And understanding these forces is critical, because they are the same forces that will eventually drive silver dramatically higher. Force 1, central bank buying at record levels. For 3 consecutive years, central banks globally have been purchasing physical gold at the highest levels ever recorded. China has been buying for 16 consecutive months without pause. Turkey, India, Poland and Kazakhstan. Central banks across the developing world are systematically moving their reserves out of dollar-denominated assets and into physical gold. This buying is strategic. It is not speculative. It is sovereign nations reducing their dependence on a financial system dominated by the US dollar. And strategic sovereign buying does not reverse because of a single bad data point. It continues because the underlying reason, dollar dependency reduction, has not been resolved. Force 2, Federal Reserve rate cuts weakening the dollar. Every rate cut reduces the appeal of dollar-denominated assets. A weaker dollar makes gold, priced globally in dollars, more attractive to every international buyer. European buyers, Asian buyers, Middle Eastern sovereign wealth funds, they all get more gold for their local currency when the dollar weakens. Rate cuts also reduce the opportunity cost of holding gold. When interest rates are high, investors can earn significant returns holding cash or bonds. When rates fall, the return on cash falls. And gold, which yields nothing but loses no purchasing power, becomes relatively more attractive. Force 3, geopolitical safe haven demand. Iran escalation to US-China trade tensions. Russia-Ukraine conflict. Multiple simultaneous geopolitical stress points are driving capital into safe haven assets. Gold has been the primary safe haven asset for 5,000 years. That does not change because of a single news cycle. 3 forces, all structural, all sustained, all pointing in the same direction. $5,000 gold is the mathematical result. Now, the number that explains everything about why silver is not moving and what happens when it does. The gold-silver ratio currently sits at approximately 65 to 1. That means it takes 65 ounces of silver to buy 1 ounce of gold right now. The long-term historical average of this ratio is 47 to 1. In 2011, during the last major silver bull market, it compressed to 32 to 1. In 2020, it compressed to 65 to 1 before silver exploded higher. With gold at $5,000, here's what different ratio levels imply for silver price. At 60 to 1, silver should be $83. At 50 to 1, silver should be $100. At 40 to 1, silver should be $125. At 32 to 1, like 2011, silver should be $156. Silver is currently trading significantly below every single one of those implied values. That gap between where silver trades today and where historical ratios say it belongs is the entire thesis. And this gap does not stay open forever. Every major gold bull market in modern history has eventually seen silver close that gap, violently fast, and further than most investors expected. So if the ratio says silver should be at $100 or higher, why is it not moving? The same answer we gave for COMEX vault drainage. The same answer we gave for industrial demand, the paper market. Silver price today is not set by people buying physical silver bars or coins. It is not set by industrial manufacturers ordering silver for their factories. It is not set by investors looking at the gold-silver ratio and calculating implied fair value. Silver spot price is set by futures traders on COMEX, trading paper contracts, responding to short-term macroeconomic signals, dollar movements, interest rate expectations, risk sentiment, Federal Reserve language. These paper traders are not looking at the gold-silver ratio and saying silver is historically cheap. They are looking at the dollar index. They are looking at equity market volatility. They are looking at short-term technical levels on silver futures charts. And right now, dollar strength from recent technical bounces, rising bond yields, and pre-Fed meeting positioning is creating short-term headwinds for silver in the paper market. Even as the physical and fundamental reality screams that silver is historically undervalued. There's a second reason silver is lagging gold specifically. Silver is not just a monetary metal. It is also an industrial metal. Approximately 60% of silver demand comes from industrial use. Gold has almost no industrial demand. When markets get nervous about global economic growth, silver gets hit by 2 forces simultaneously. Monetary selling, same as gold, and industrial demand pessimism, unique to silver. Gold only faces monetary selling, silver faces both. This dual sensitivity to economic fear is why silver consistently lags gold during the early stages of a precious metals bull market, and why silver consistently outperforms gold dramatically during the later stages, when economic fear is replaced by inflation fear and the industrial demand story reasserts itself. We are in the early to middle stages of this precious metal cycle. Gold has moved first, silver always follows. That is not prediction. That is documented market behavior across every precious metals bull market in modern history. Every single major gold bull market in modern history has been followed by a silver move that exceeded gold's percentage gains. Every single time, without exception. 2008 to 2011. Gold went from $700 to $1,900, a 170% move. Silver went from $8 to $49, a 512% move. Silver outperformed gold by 3 times in percentage terms. 2018 to 2020. Gold went from $1,100 to $2,000, an 82% move. Silver went from $14 to $30, a 114% move. Silver outperformed gold again. The pattern is consistent across decades of data. Gold moves first, silver lags. Then silver catches up and exceeds gold's percentage move by a significant margin. We are living through the gold move right now. Gold from $2,000 to $5,000, a 150% move already completed. Silver has not made its corresponding move yet. At the ratios and percentage relationships that have characterized every previous cycle, silver's corresponding move would take it from current levels to somewhere between $100 and $150 per ounce. That is not a prediction based on hope. That is pattern recognition based on documented market behavior across multiple complete precious metal cycles spanning decades of data. Here is what the data shows smart money is doing while silver lags gold. The CFTC Commitment of Traders report, published every Friday, shows managed money building net long positions in silver futures. Not reducing them, not going flat. Building them consistently, week after week. These are the most sophisticated traders in the silver market. They have access to data and research that retail investors cannot match. And they are positioned for silver going significantly higher. Not for silver staying flat while gold runs alone. Physical silver demand from industrial buyers continues at record levels. Solar manufacturers, EV producers, semiconductor fabricators. These buyers are not deterred by paper price weakness. They need the physical metal. They are ordering it through long-term contracts at prices that reflect genuine physical scarcity, not the paper futures price. COMEX registered silver inventory continues declining. The physical silver backing the paper market is leaving the system. Smart money taking physical delivery from COMEX does not do so because they expect prices to stay flat. They do so because they expect prices to rise significantly. 3 data points, all confirming the same conclusion. Smart money is accumulating silver before the paper price reflects what the physical market already knows. What breaks silver's lag and triggers the catch-up move? Historically, 3 types of catalysts have triggered silver's explosive catch-up moves after periods of lagging gold. Catalyst 1, Federal Reserve policy shift. When the Fed signals aggressive rate cuts, dollar weakness accelerates. Accelerating dollar weakness removes the paper market headwind that has been suppressing silver. The ratio compression begins, and silver moves fast. Catalyst 2, physical delivery stress on COMEX. When enough contract holders demand physical delivery simultaneously, and registered inventory cannot satisfy those demands, paper price is forced to reflect physical reality rapidly. We are watching registered inventory decline toward levels where this becomes a genuine risk. Catalyst 3, retail and institutional FOMO. When gold hits price levels that generate mainstream media coverage, retail investors who missed gold begin looking for the next move. They find silver, they find the ratio. They find that silver is historically cheap relative to gold, and they buy. That buying, added on top of existing institutional positioning, creates the momentum that takes silver from lagging to leading. All 3 catalysts are closer to activation today than they were 6 months ago. None have fully triggered yet, but the conditions for all 3 are building simultaneously. This is not financial advice. Always consult a qualified financial professional before making investment decisions. The practical framework for silver investors right now is straightforward. If you already hold physical silver, the data environment has never been more supportive of your thesis. Gold at 5,000 confirms the precious metals bull market is real and sustained. The ratio at 65 to 1 confirms silver is historically cheap relative to gold. Smart money is positioned long. Industrial demand is at records. COMEX vaults are draining. Every data point supports patience and conviction. If you are considering entering, understand that silver's lag behind gold is not a signal that silver is broken. It is a signal that silver is early in its cycle. The investors who benefit most from silver's catch-up moves are the ones who accumulate during the lag, not the ones who chase the move after it begins. Dollar cost average. Build positions gradually over weeks and months. Physical silver where possible. It carries no counterparty risk and cannot be inflated away. Remove the psychological pressure of timing a perfect entry. The direction the data points is clear. The timing is the only unknown. We do not sell silver. We do not sell anything on this channel. Anyone claiming to be Stack AG and offering precious metals or investment products is a scammer. Block and report immediately. Gold at $5,000. Silver not moving. Two facts that cannot both remain true forever, because history says they never do. Every time gold has run while silver lagged, silver eventually caught up and exceeded, and left investors who waited wishing they had acted when the data was clear and the price was still low. The data is clear right now. Gold at 5,000. Ratio at 65 to 1. Smart money positioned, long industrial demand at records. COMEX vaults draining. Physical market pricing above paper market levels. Silver is not broken. Silver is early. Stack AG is here every single day tracking every data point that tells us when early becomes now. Subscribe, hit the bell. Share this with one investor who is confused about why silver is not moving while gold hits 5,000. I am Stack AG at Invest with Logic. Not hype. See you tomorrow.